Welcome back to the deep dive. So when finance teams start talking transformation, especially reporting automation, the conversation nearly always jumps straight to the high-end tech.
Oh, absolutely. You hear all the buzzwords, right? Machine learning, AI dashboards, maybe even complex Python scripts if the CFO is feeling ambitious.
It feels like that's the standard playbook. You need the fancy tools, Power Query, DAX, scripting, to get real scalable automation going.
That's definitely the common assumption.
But the research we dug into for this deep dive, it's from a really seasoned CPA, someone who's actually led these big transformation projects. And they offer, well, a pretty important course correction.
Yeah, they argue something like 80% of automation efforts actually fail, and not because the code is bad.
Right, not the code, it's the data architecture underneath.
Exactly. So our main point today, really, is that true scalable financial reporting automation, it doesn't kick off with code or buying new software. It starts much deeper.
Deeper.
With the structural integrity of your data, specifically your trial balance, your TB, and your chart of accounts, the CoA.
Okay.
Because if that underlying data scheme is weak or messy, your automation project, it's pretty much guaranteed to hit a wall. Or, maybe worse, it just reliably produces garbage output. Faster garbage, maybe.
That's a really critical distinction, isn't it? We're often pushed towards speed, towards getting the tech implemented. But you're suggesting the biggest mistake is trying to script your way around a fundamental data problem.
Precisely.
So this deep dive, it's kind of a shortcut then, to understand that single most crucial piece, the structure you need for financial transformation that actually lasts.
Right. And maybe before we go further, we should just quickly nail down the relationship between those key terms, because people sometimes use GL, CoA, and TB almost interchangeably.
Good point. Let's clarify.
Okay, think of it like a hierarchy. The general ledger, the GL, that's the massive detailed journal. It's every single transaction, line by line, the whole history.
The raw data dump, essentially.
Kind of, yeah. Then the chart of accounts, the CoA, that's like the dictionary. And the rule book, it tells you what those GL transactions should be called, how they need to be categorized. It imposes order.
Okay, GL is detail, CoA is structure, and the trial balance.
The TB is the result. It's the final aggregated summary that comes directly from the GL, but it's organized by the CoA, and crucially, it's balanced. Debits equal credits.
So the TB is the key output of the month's end close.
Fundamentally, yes. The whole close process is about delivering an accurate, reliable, and importantly, well-structured TB. That's the foundation for everything else.
Oh, okay, so if the TB and the underlying GL details are this, bedrock, why do so many companies, smart companies who get accounting, still run into trouble when they try to automate reporting? Why does the tech fail them?
Well, that leads us right into this anecdote from the CPA in our source material. It's quite telling.
Yeah, tell us about that.
They described this project, had all the right software, sharp engineers ready to go. Everything looked set. But when they actually started writing the scripts, specifically to automate the cash flow statement,
Broke.
constantly, the workflow just kept failing.
What was the root cause then, if they had the tools?
The foundation was there. Sure, they had a TB.
Yeah.
But the structural integrity, it was basically zero.
How so?
Accounts had inconsistent names from one month to the next. The chart of accounts itself, it was designed like 20 years ago purely for compliance. It wasn't built for the kind of granular automated reporting they needed today. So they realized their whole focus, their enthusiasm for the automation tools was misplaced. They were trying to build this sophisticated tech layer on quicksand.
Yeah, it's that classic problem, isn't it? Trying to build a skyscraper on a foundation meant for a shed.
Exactly. And that experience really boiled down to this powerful lesson. Automation doesn't start with code. It starts with structure.
That's the key insight.
It changes everything, because think about it. We often see finance teams using powerful tools, maybe Python or Power Query, mainly to clean the data every single month.
Right, the pre-processing step.
Which means, maybe 80% of your scripting effort, your budget, is just spent on wrestling the data into shape before you can even start the actual analysis or reporting automation.
That's incredibly inefficient.
Totally. If your CoA is a disorganized mess, the automation tech just processes that mess more efficiently. The output is consistently, reliably wrong, or at least untrustworthy.
Okay, so let's pivot then. Let's get practical. If we accept this premise, the TB needs thoughtful design. So all the downstream stuff, balance sheet, income statement, cash flow, even the notes can be built directly from it. What does that actually require? What are the specific actionable things you need in that data architecture?
Right. It means focusing on granular design and starting right at the source, with the chart of accounts structure itself.
Okay, give us the specifics. What does that look like?
First big one, granularity and separation. You absolutely have to keep distinct GL lines for items that you know you'll need separately in different reports or disclosures.
Can you give an example?
Sure. Take the CAD flow statement. It's notoriously tricky to automate, right?
Definitely.
Well, for reliable automation, you must have separate GL accounts for things like income tax paid and interest paid.
Because they go into different sections, operating versus financing or investing activities.
Exactly. If you just lump them together in some generic other cash disbursements account, how is your script supposed to figure out which is which? It can't, reliably. So the automation breaks or gives you bad numbers.
Okay. But pushing for that level of granularity, doesn't that make the upfront manual work, like coding invoices or journal entries, a bit heavier for the team each month?
It can, initially.
Yeah.
It requires more discipline up front. But that's the trade-off you make for huge efficiency gains later through automation. And think about the notes to the financial statements. They demand really deep detail. Which brings us to the second point, categorization for clarity. Let's talk fixed assets, CapEx. You can't just have one lump sum fixed asset account. It's not enough.
What do you need instead?
You need separate lines, clearly defined in your CoA, for things like asset additions, asset disposals, and maybe transfers between categories.
Ah, I see where you're going.
Yeah.
If you force that separation in the CoA and in the GL posting,
Right.
then your automation tools can just pull those lines directly. They can effortlessly generate the detailed fixed asset note disclosures, the whole roll forward schedule. It's practically pre-built.
Because you've designed the input structure, anticipating the output requirements.
Exactly right. You're building the blueprint for the output right into the CoA. Now, maybe the most critical principle, especially for making automation sustainable over time and avoiding technical debt,
Yeah.
is consistency across time.
Me.
Meaning using a standardized structure, the same account names, the same logic every single month, year after year. That consistency is the absolute backbone. Without it, automation tools just break. Okay, let's play that out. For listeners using tools like, say, DAX in Power BI or scripts in Power Query, what happens technically when that consistency fails? Someone changes an account name mid-year.
Oh, the failure's usually immediate and painful. Think
Yeah.
about it. Your Power Query script, or maybe a DAX measure, it's often hard-coded or is configured to look for a specific account number, like a 11004, or a specific column header name from your GL export file.
Right.
So if someone in finance, maybe in month 6, decides, you know what, account 11004 isn't clear enough, let's rename it to dealer bonus prepaid. Or maybe they reuse that old account number for something totally new.
Boom, the script breaks.
Instantly. It either throws an error because it can't find 11,004, or maybe worse, it pulls data from the wrong account if the number was reused, leading to silent errors in your reports.
So a simple administrative change in accounting causes a major technical problem downstream.
It's exactly. What seems like a minor cleanup task forces a technical user, someone maybe in FP&A or BI, to spend hours debugging their scripts, trying to figure out what changed in the source data. That's not structure, that's chaos.
And that's where the whole efficiency promise of automation just evaporates.
Completely. Which leads to the last point on structure. Smart naming conventions and metadata. Don't rely on cryptic, 3-digit codes from 1985.
Use meaningful names.
Yes. Use clear, descriptive names like warranty provision, current liability, instead of just, account 2150. Clarity reduces ambiguity. It prevents errors when you start feeding this structured data into more complex automated workflows. Make it human-readable and machine-readable.
Okay, let's talk about the chart of accounts itself then as this ultimate blueprint. The sources really emphasize that the CoA isn't static. It's something that's fully within the finance team's control, and it should be adapted and expanded.
Yeah, it's a living document, or should be.
But designing one blueprint, one CoA, that works for everyone. Management wants their view, external auditors need the GAAP or IFRS view, the tax department needs their specific roll-ups. It sounds almost impossible to satisfy all those masters with one structure.
It's definitely a challenge, but it's not impossible. The key is often using segmentation within the account structure, or using metadata tags effectively.
Segmentation, like breaking the account number into parts.
Exactly. A really well-designed modern CoA should be built to serve multiple reporting needs simultaneously. Internal management reports, external financial statements under GAAP or IFRS, tax filings like the Schedule 1 or T2 reconciliation, maybe even regulatory stuff like Statistics Canada submissions.
How does segmentation help you pull, say, a GAAP report versus a tax report from the same underlying GL data without needing like 5 different CoA mappings?
Okay, imagine an account string like this for, say, employee salaries, 5100, 100 GAPR.
Break that down for us.
Sure, 5100 might be the natural account salaries, 100 could be the cost center or department, then GA could be a segment specifically for the GAAP roll-up hierarchy, and PR could be another segment used purely for the tax reconciliation, maybe grouping personnel-related costs.
Ah, so the segments act like built-in tags.
Precisely. So when you want to generate your GAAP income statement, your automation tool filters or pivots based on the GA segment. When you need the tax schedule detail, you filter on the PR segment. You're slicing and dicing the same core transaction data in multiple ways based on the intelligence built into the account structure itself.
That completely reframes the CoA, doesn't it? It's not just a flat list of accounts anymore. It's a dynamic, multidimensional categorization engine.
That's the goal. You're moving data management towards a schema that's inherently designed for multidimensional analysis and reporting right from the start. Once you get that architecture right, well, the technical automation part actually becomes much more logical, much easier.
Okay, so let's talk methodology then. If you've done the hard work on structure, what's the logical sequence the sources suggest for actually implementing the automation successfully?
They outline a pretty clear 4-step approach.
Yeah.
And notice, structure is absolutely step 1.
What are the steps?
Okay, step 1. Structure the data, design that thoughtful CoA, define your TB layout standards, maybe even standardize your journal entry templates, get the foundation solid.
Makes sense. Step 2.
Step 2, standardize the process. This is about consistency. Use consistent naming conventions everywhere. Define standard mapping logic. Implement clear reconciliation procedures. Make the process around the data repeatable and predictable.
Structure first, then process standardization. Got it. Step 3 must be the tech.
Step 3 is automate the mechanics. Now you bring in your tools, Power Query, DAX, Python, RPA, whatever fits. Use them to execute the repeatable data flows, the calculations, the report generation that you've already clearly defined based on the solid structure and standardized process.
And the final step? It's not just set it and forget it, right?
Definitely not. Step 4 is crucial. Analyze and adapt. Review the automated outputs critically. Are they matching expectations? If not, why? Refine your mappings or maybe even tweak the structure based on what you learn. Continuously improve the system. It's an ongoing cycle.
That progression feels much more robust. Structure, standardize, automate, adapt. It makes automation seem less like a frantic tech project and more like an outcome of good data governance.
That's a great way to put it.
But
I'm still thinking about the granularity challenge.
yeah,
Especially for the notes to the financial statements. Those often need details that live below the summarized trial balance level, right?
Yeah.
How do you automate that level of detail?
you're right. And this is where journal entries, the JEs themselves, become absolutely critical. They are the bridge.
How so? Usually the description killed in a JE is just free text, notes for the reviewer.
And that's the missed opportunity. Our sources really stress this, that JE description field shouldn't be treated like a messy notepad. It should be treated as another valuable structured data point. You mean put structure inside the description field, like enforce a format.
Absolutely. Imagine using a standardized format, maybe using delimiters like the pipe symbol. For example, a description could look like accrual HR Dept Q3 bonus, Sept 2024, Ref 1234.
Okay, I see. So that's like journal type, cost center, projector purpose, period, reference number.
Exactly. Or some variation that works for your business. The point is, instead of having an automation script, try to use like natural language processing to guess the meaning of thousands of unique free text descriptions.
Which sounds like a nightmare.
The script can just use the pipe delimiter, or whatever you choose, to instantly parse that description. It can automatically categorize the JE based on the first segment, type, the second department, the third purpose, and so on.
That's actually brilliant. So you could automatically group all the accrual type journals tagged to HR Dept to help build the accrued liabilities note disclosure.
Precisely. Without any manual tagging after the fact. It provides the necessary detail for note automation. And this idea requires discipline, of course, and it ties directly into another crucial practice, sub-account grouping within the JE itself.
Tell us more about that grouping aspect.
It means you have to actively fight against using generalized catch-all accounts, especially in journal entries. instead of booking a whole bunch of different items into one generic other expenses line in a journal.
Which everyone loves to do because it's easy.
Right. You need to force the discipline to break it down. Use separate, dedicated lines within that same journal entry for utilities, software subscriptions, professional fees, whatever the components are. Use the specific GL accounts already set up in your well-structured CoA.
So you're providing the detailed mapping needed for both external financial statement notes and probably internal management KPIs right at the point of data entry.
Exactly. When the data is categorized correctly at the entry point, generating the detailed output reports becomes almost effortless for the automation tools.
And I guess using consistent journal types, like clearly labeling JEs as accrual, reversal, reclass, in company, that acts as another powerful structural filter for automation too, doesn't it?
It really does. Defining and consistently applying those JE types allows your automation workflows to filter entries easily. Think about complex processes like intercompany eliminations or validating accrual reversals. If the JEs are clearly typed, the automation logic becomes much simpler, more reliable, and easier to audit.
Okay, so when you combine all these pieces, the segmented chart of accounts, the disciplined structured journal entry descriptions, the sub-account grouping, the consistent JE types, you've essentially created this strong connective tissue.
That's a perfect way to describe it.
It links that massive underlying GL detail all the way up to the summarized financial statements and down into the granular note disclosures.
Exactly. And when it's done right, you achieve automated transparency. You should be able to click on a number in a note disclosure, say the additions line in your property, plant, and equipment roll forward, or the detail in your accrued liabilities footnote, and trace it directly back through the system to its specific originating journal entry lines, all without manually digging through spreadsheets.
This whole deep dive, it really does reframe the financial transformation challenge, doesn't it? It shifts the focus. It's less about which fancy tool you buy.
And much more about the foundational architecture and the data integrity you build first.
Yeah.
And that's the core benefit we're talking about. It's about moving your finance automation effort away from this constant, frustrating cycle of technical debt, where your team is always fixing the data or debugging scripts because the input changed,
Right.
and moving towards a truly sustainable, scalable process, one where the technology reliably executes well-defined rules on well-structured data. That shift, fundamentally, it's about gaining much greater control, transparency, and trust in your financial reporting.
And saving countless hours, presumably.
Oh, absolutely. Every hour your team spends thoughtfully structuring the CoA and standardizing JE processes today likely saves 10 hours of reactive firefighting and manual cleanup tomorrow.
So the big takeaway for everyone listening, the insight that really needs to stick, is that the most successful, sustainable automation projects, they didn't necessarily start with the most cutting-edge code.
No, they started with clean, logical, well-structured data architecture. Right there in the general ledger and the chart of accounts. That was the prerequisite.
Future efficiency is basically a direct result of thoughtful structural design work done today.
Couldn't have said it better myself.
Yeah.
So for you, the listener, maybe you're an analyst, a controller, a manager, thinking about driving automation in your finance function. The crucial question you need to take away and really act on is simple, but it's profound. Ask yourself, is my trial balance, is my CoA actually built for automation? Or is it really just built for manual cleanup every month?
Get that initial architecture right.
And the rest of the automation journey becomes so much more predictable and, frankly, much more successful.